I think it's a natural adjustment that markets are having to make to reflect higher bond yields. I think it's important to take a step back and to say that, if you'd been told that 10-year US Treasury yields would rise 65 basis points in the first 2 and a bit months of the year, and you'd still see global stocks higher, I think people would be surprised. So I think we've all become pretty myopic about the potential disruption for higher bond yields to the broad stock markets. Having said that, clearly markets are disappointed by what Jerome Powell said yesterday. I don't think it was dovish enough to support the type of views that markets wanted to see. Some vague assurance that policy will remain accommodative and some sort of tolerance for rising bond yields, I don't think gave the markets really quite enough. And I think the markets also want to see slightly more evidence that there is a so-called Powell put. That's to say that the Fed will underwrite some kind of level of market turbulence should that occur. And again, I think markets generally are a little bit concerned that central banks are becoming a bit insouciant about this rise in bond yields. But I don't view it as a huge headwind potentially going forwards, because we are seeing the strongest global growth that we would have seen since the early 80s. We are also seeing the strongest delivery in terms of corporate profit growth that we've seen certainly since the GFC. And if you ally the very strong fiscal and monetary policy stimulus that we're seeing, if inflation does rise, but in the way that central banks are happy with a cyclical pickup this year and a moderation next year, that should really be a tailwind for risk assets in the months ahead. So it's really the markets adjusting to a higher rate landscape. I think what would trouble me a lot more would be a big rise in real rates. When we had the 2013 so-called bond taper tantrum, what happened there was that the Fed floated the idea of potentially tapering asset purchases. That hasn't happened this time, by the way, but we did see a collapse in inflation expectations as a consequence of that as real rates rose. Now, if we were to see real rates rising more rapidly than nominal rates, and they're currently not doing that, I'd be somewhat more concerned.